Here are 7 ways to finance your startup. Yes, in this video we'll go through a bit of a theory. I get my laptop in here and there is a document designed some time ago. So please, there is a link down below in the comments. Straight away you can go download it, and then while you're watching this video you'll have a look and understand what I'm here about to say. Okay, let's dive in. So it's really crucial to understand. So first of all, let's review the 7 typical ways to fund your startup journey. So first of all, it is bootstrapping. Bootstrapping is when you're not taking any external capital on. It's when you are building the business model, you're starting to sell your product or service, and then you're earning money, and this is how you finance your startup journey or business journey. It is the best way from the perspective of equity. So you keep all ownership of your company for yourself. You're not sharing your company with anyone. It is all for you. So meaning then, in 5-10 years, when you're gonna get profits, a lot of profits, this all profits comes to you, so you don't need to share the equity. So this is number 1. Number 2 is crowdfunding. So crowdfunding is when you create a crowdfunding campaign, and then you go to the crowdfunding marketplace or platform, and then you ask for money from other people. And this is, the name originates from the crowdfunded. So if your product or service is cool and people believe in it, so they might all tip in something. They tip in $5 or 10 or 100, whatever it is, and usually they call these so-called backers. They back you up, and you are after that taking their money and proceeding to building your product or service. And then also frequently you'll say thank you to them in terms of, you might give them product discounts or merch, or they might be your first clients. I think this is good idea to actually validate your business idea. So you might launch a crowdfunding campaign, and if you see people like it, so then it means that okay, there is a demand. So it means that okay, maybe there is something valuable, I should proceed. And examples of places that you might need to search is Kickstarter, Indiegogo, or Seedrs. And this was about crowdfunding. Number 3 is angel investors. Angel investors are, so-called angel investors. So these are the people, they earn money somewhere, and then they're searching to deploy their capital somewhere. And so you might find those guys, and then you say, okay, can you give me money, and I'll be doing this and this, and then you exchange it for some equity. So this person becomes a shareholder of your company. This person is now owning a portion of your business, and then because they're investing so on early stages, so you might need to give up actually a lot of equity. Sometimes it's even 20% of your company will go to this angel investor. The bonus of this scheme is that the angel investors are frequently experienced individuals with a lot of connections. So they're not only giving you money, it's not like a loan, you're like, okay, 10, 20,000, 100,000, but then also they're giving you expertise, and then they're opening doors for you. So with the angel investor on board, you might have bigger chances of success rather than without it. So I would definitely recommend at least exploring this possibility. And then also you need to know that angel investors, they know that most probably you'll fail. Just on the market, if you look around, that mostly companies and startups, everybody is failing. So then they're, in most of the cases, are ready to give up this money and then never see them back. The number 4 is venture capital. Not everybody is ready for the venture capital, and venture capital, it is a specific type of a capital that is deployed to the project. Not everybody is eligible, and I think something really important that you need to understand before you go towards venture capital is that the pace is high. So it means that you would need to build a big company in a short period of time in order to be able to exit yourself and exit your investors. And these in venture capital firms, these investors are looking into 10, 16x returns within 10 years, depending on the fund duration. So they will be pushing you hard, and you might be like, okay, our company is this big, we want to enjoy, we want to have a lifestyle business. No, They will not agree on that. If you go towards venture capital, it means that you're taking this money and then you are committed to growing your company. You're committed to showing the returns to investors, and you're committed to scaling the company this much, in order to, exit yourself and exit them. And I think venture capital backed, it is a special category. So I would definitely recommend you to dive in deeper there. And then, for example, for myself, I used to work for Swappy. Swappy is a venture-backed company. We've been growing 3x per year in the headcount and revenue. It was like real fun. But then it's not for everybody. Sometimes it's just, too fast. And then you need to make a choice. Is this for you or not? And then number 5 is grants. I think grants is one of those that it almost fits everybody. We are in Finland. In Finland, we have, for example, Business Finland grants. So there's something called Tempo, or there is something like Ely-keskus. I think they're giving also grants for entrepreneurship and startup founders. They all have different requirements. So you would need to, discover, understand the requirements, see if you're eligible for that or not. But I definitely would recommend exploring it, because grants are something that you don't need to pay back. And something they just give you money and then you can spend on building your company and continuing. So grants, definitely. The revenue-based financing. Again, so it is another type of funding. It's another type of financing that you might get. And in this case, it means that you really need to showcase your revenue, right? So it's even called revenue-based financing. So first of all, you need to prove that you can sell, you have the certain revenues that are coming into your company, and you need to show the projection. So basically this cash machine already need to be built. It needs to be crystal clear. What is your business model? Okay, how does the marketing work? You need to have the marketing playbook, meaning that, okay, I put the money here. This is where the customers are coming from. I want to put more money. I put more money. I get more revenue. I get more profits. And this is how I actually paying back. Because this revenue-based financing, you need to pay it back, right? So then you just take more revenue, you scale the company, you earn profits, and then you give this kind of so-called loan back. Number 7 is bank loans. And bank loans are really great, but then again, you need to understand pros and cons, and then you need to understand how to utilize it better. You need to understand the percentage. Sometimes percentages are way higher, and percentages are might be like just too much. And especially now, for example, in Finland, the percentages on all types of loans are like way higher because of crisis situation. But this being said, depending on your model, and sometimes you might need something quick. So something that, okay, you understand, like, okay, I can take a bank loan now. I need to, open this another business unit, or I need to spend a bit more money on marketing. And then you have a clear path. Okay, this is how I accumulate it back. This is how I earn it back. And after that, you just pay it back. And then I also put some examples there for OP, Nordea, QRed. So there's a bunch of them. You choose yourself, but again, understand if you're eligible, understand if it works for you or if it's not. Also, sometimes there are requirements. Not everybody is eligible for loans straight away. You need to prove that your company kind of functioned for some time already, or sometimes you need to have something to back up the loan, right? So what if you go bankrupt? Like, bank will come and ask for money back. So check it out. But again, so this being said, all these 7 ways of financing your business, they have their pros and cons, and I've explained them roughly here, so then you guys can go and check it out. And then again, so once you've understand all of them, then the step 2 is that you need to choose which one that you need to use. And these ways of financing are super unique. By the way, also, like, I need to tell you that sometimes you don't even need to finance yourself. Sometimes you need to be self-financed, which is bootstrapped actually. So you earn money, you spend money, and then you go forward. But then in other cases, you need to finance. And here's the decision tree that you might want to use. And then it's pretty simple that there are separations. You ask yourself a question: what stage your startup in or your company in? Then you choose the stage. Then you ask the second question. So for example, if I'm early stage, are you comfortable of giving up equity? yes, no, simple. So yes, there is only like, three or four options. If it's no, then there are like 2 or 3 options. So you narrow it down, and then you go back, you understand pros and cons, and then you dive into it, and then you continue. So again, you can download all this printout from the link down below. Use it, understand it, use this decision tree, and let me know down in the comments how was it. Let me know, what do you think? Was this useful, or was it like way too technical and we don't want to listen about this anymore? And please support us with a like and leave a subscribe, and we see you next time.